The craziness in the stock market seems to never end. The US CPI numbers come out lower than expected. The stock market goes the other way. The UK economy is not doing so well, with inflation very much not under control. So in this video, I'm going to be showing you my Trading 212 portfolio. So the value of my Trading 212 Invest portfolio currently stands at £3,209, and in this month I only deposited £200. However, my returns have been slightly higher than that. So as you can see, I have free funds of 19 pence, and this month has been quite good in terms of return, with a 2.46% return, netting me around £76. If I go into free shares, you can see that I have received £320 total in free shares, with the new promotion just coming out the other day. So if you would like to sign up, please use my link and we will both be getting a free share. So I'm going to go through all my holdings, what I have, and then I'm going to go to my Trading 212 ISA account and show you how I've been making money using that. So starting off, I have 0.12 shares in Walt Disney, and that is down by 11%. So over the past month, Walt Disney has not been doing too well, with a huge dip just a few days ago. Not exactly sure why that is, but maybe it has something to do with the streaming platforms, maybe something to do with Netflix. I have no idea. Next, I have Vodafone, so 35 shares in Vodafone, and that is down by 1.22%, which is not too bad at all. And currently, Vodafone is still paying a high dividend of 8%, which is really good. And over the past month, it did rise and then dip again, so it kind of stayed flat overall. I'm not going to buy any more shares in Vodafone, but it could be a good investment for the long term, where Vodafone was valued a lot more in the previous years. So next, I have 0.01 shares, so only £1 worth in the Vanguard S&P 500. And as you know, the US economy has been actually doing better than expected, but the interest rates were raised by a few basis points, meaning that investors aren't sure when the last increase is going to be made, and then when interest rates are going to start declining again. So for now, the S&P 500 is just going up and down, up and down, and up and down. So next, I have 0.8 shares in the Germany All Cap, and that is down by only 1%, so not doing too bad. Over the past month, you can see that the Germany All Cap has been going down slowly, but I think in the long term, Germany will be fine. So as a long-term hold and as an ETF provided by Vanguard, actually, I think that possibly could be a decent place to put your money. In addition to that, I have a FTSE Japan, and that is up by 8%. So as you can see, over the past month, the FTSE Japan has been doing really well, and it is trading at near all-time highs. So FTSE Japan is doing really well. It doesn't show you the dividend yield here, but it does pay a dividend yield. So I think that the FTSE Japan could be a good place to put your money. However, I think there's too much volatility for me for putting money into Japan, because their economy is quite stagnant and they still haven't recovered from their highs of the 90s, or maybe they have, but they're still very close and not having beat that. So I don't think for long term I will be putting more money into the Vanguard FTSE Japan. Literally £1 in the FTSE All World ETF, and that is down by only 2%, so that's a 2 pence loss. I do get questions saying why bother putting such small amounts into these holdings, and my reason is, when I did start this portfolio, I started this channel with it, and I wanted to show people that you can start investing with as little as £1. Of course, it doesn't really make sense, I agree with you, to actually just put in £1 into something, because in the long term, even if that company triples, doubles, or whatever, you're only going to be making another £1, and then with dividends compounded, really you're not going to make that much money at all. What I want to show you is that investing regularly, putting in at least £200 per month, which is what I'm doing right now with my Trading 212 account, because I have maxed out my ISA, I don't feel like I should be putting too much money into my invest account. So I don't actually put in any more money into these companies. These are just showing you updates of what would happen if you literally just invested £1. That being said, I do put in money into only one ETF, and I will show you that in a bit. So next is Unilever, again £1 holding, that is up by 12%, so that's a gain of around 11 to 12 pence. Tesla over the past month has been doing really badly. However, Elon Musk has appointed a new CEO of Twitter, and we probably would be seeing Tesla stocks rise in direct response to that, because you know how stock market is, it's very weird. And Tesla is just one of those companies that people are so obsessed with, and any small changes to news that comes out, any failed launches from SpaceX, really does take Tesla's value straight down. And I do think this is reflected by this. I think this is where I don't read too much into it, but I think SpaceX mission launch failed, something like that. I think this is in direct response to that. So as you can see, Tesla is a company with very high volatility, and I'm not sure what the value is, if it's overvalued or not, but I will not be investing more in Tesla because it's too speculative for me. Next is Tesco, and that is up by 11%. So all these supermarket companies in the UK have been experiencing lots of profits, because the wholesale prices for a lot of food has gone down over the past month. However, this has not been translated into lower costs for the consumer, which is honestly very anger provoking, because these companies are super quick to raise prices when wholesale prices are high. In fact, they are still raising prices without you realizing, because I know from someone who buys meal deals every day that the actual food is getting a lot smaller in quantity, meaning that they are going to keep making profits, and Tesco as a long hold could possibly be a very good hold for you. It does pay a dividend of 3.8%, which is much higher than average, so take that for what it is, but Tesco is doing well. You can see from the income statement and the balance sheet, their revenue is just so high, and as you can see from their balance sheet, they have a lot more assets to cover all their liabilities. Starbucks is a company that is up by 3% in the last month. As you can see, it went through a huge downturn. Not exactly sure why that is. It looks like it's in response to a news event that could have come out, so if you guys know what that is, make sure to let me know in the comments down below. But anyway, Starbucks is up still in my portfolio by 3%. That's a 67 pence gain. Rolls-Royce, I have 21 shares and that is up by 25%. So I think over the past month, Rolls-Royce again has not been doing too good. I don't know what happened around the 10th of May, but their shares have plummeted. But anyway, 25% gain is not too bad. That's a £6.44 gain for me. Rolls-Royce does not currently pay dividends. I do believe in the future Rolls-Royce could be a company that, you know, gets back up to its £10 mark. Next, I have Pinterest, so 0.04 shares. Again, £1 holding in that, so nothing too much to be afraid to lose of. That is down by 17%. So another tech company did really bad. A sharp decrease in the 27th of April and then more and more decreases. That is down by 17% and that is a loss of 17 pence. Next, I have Orange, so 1 share in Orange and that is up by around 6%, I will say. So over the past month, you can see Orange has been inclining, if that's even a word that they use in the stock market, and then it's seen a little decline. But I'm happy with that, so that's a 5% gain, that's 59 pence. Nvidia has been doing really well over the past 3 months, with the past month being really good as well. So I think Nvidia is one of those companies that are going to be pivotal going forward, not only just because of AI, but I do think, if you've watched my other video, I have said it in that too, that going forward, I think the video gaming industry is going to become very, very big, because I've seen things like the Steam Deck, the Nintendo Switch, and now the Asus ROG Ally, which are gaming handhelds which let you play basically every game that ever existed in the past, you know, 10-20 years on the palm of your hands, because these chips are getting so powerful. They're using way less power that they can actually be put into gaming handhelds, and essentially I do think they will replace consoles in a big fashion, such as like the PlayStation 5 and the Xbox. And the beauty of this model is that because computers advance so quickly, instead of a console that lasts up to around 7 years, and you know, you have to put in all this research and development and create consoles and then update them every 7 years, you can instead make gaming handhelds that you actually refresh every 2 years, meaning that people are kind of subscribed to the model of buying better and better every 2 years. I think there'll be a lot more money in that. I think the Nintendo Switch sold around 100 million units, and I think given the Steam Deck's success and then things like the ROG Ally, gaming is going to be a huge thing. Handheld gaming is going to be a very, very huge thing. I think it's going to be much bigger than VR, but Nvidia really needs to get into the game, because AMD currently provides all the chips, all the graphics chips for games consoles and handhelds. So I think if Nvidia gets into this gaming field, kind of stops with their ego and stops producing graphics cards that are so bloody expensive that no one wants to buy anymore, then they will be making a lot more money. And that's just half of it. The next is AI. Nvidia is leading in AI technologies. Their graphics cards are by far the best for AI, and I think Nvidia going forward is going to be a very, very good company to hold. I didn't realize this, but Nvidia does have a dividend, but a 0.06% dividend yield, which is basically nothing really unless you have millions and millions into this company. Next, I have National Grid, and that is up by 16%, and I have half a share of that. As you can see, over the past month, National Grid has increased, so that is looking quite good. It does pay a dividend yield of quite a good dividend yield at that, at 4.49%. Next, I have Lloyds Banking Group, and of course we know over the past few months the banking sector has not been doing too well because of extremely high inflation rates. Well, actually, they're not that high compared to the 80s, but the rate of hiking, so the past 12 times the Bank of England has raised interest in a row, so that's not looking very good. You might think that's a good thing, but you know, the way that banks operate, they should be making more profit on high interest rates, but the faith in the banking sector, the faith in these banks are not at all-time highs, so shareholders are responding to that by selling their shares. So anyway, Lloyds Banking Group is down by around 15% in my account, and that is a loss of £6.87. So my next holding, I have 330 shares in the S&P 500 by GSPX. This being one of my all-time favorite ETFs to actually trade with. However, in this Trading 212 Invest account, I actually don't bother trading because there's not that much money in it and it's pretty time consuming to actually pay attention to it. But anyway, I have a return of 3.2% and that's a £72 gain. You can see that when you start putting in more money and more frequently, you do get a bigger gain when you have more money. So £72 is a lot more than if you add up all the small amounts that I've talked about before. But in my Invest account, I only really put money into the GSPX. Currently, I'm putting only £200 because I don't really care about building up my general investment account because I care more about maximizing my ISA, which I will hopefully do for the next year straight away. But what I really like about the GSPX is that it is extremely volatile. We can see that it's been hovering around £7 for a whole year. You know, you hear it on the news and you hear the stock market's gone sideways, a lost decade. I honestly think there's no such thing as a lost decade. I get questions like this all the time. You know, why should I buy this stock? It's been £7 for many years. Will I make any money? You don't actually realize the power of dollar cost averaging, which is super important. If you buy regularly, you're buying high and then you're buying the dips. Buying the dips is incredibly important. For example, if I bought it at 7.35 and then it dipped at 6.26, when I buy at 6.26, I'm getting a whole lot more of pretty much free shares. And then when it goes up again, those free shares are worth more. So as you can see, it is not a straight line. You're not making no money. If you invest regularly, you're making a lot of money when things are going down and then when they go up subsequently after that. So never actually do forget the power of dollar cost averaging. In addition to that, the GSPX does pay dividend yield, but it's very low at around 1.2 to 1.6%. Next, I have Royal Mail. I have 6.2 shares in that, and that is up by 7% roughly. I have IAG, which I have 6.3 shares, and I was told thank you by Connor last time that this is actually pretty much British Airways. That is down by 8%, and as you can see over the past month, they have been doing quite well, so making up for some of the slack from last month. So a good company maybe perhaps to invest in, not paying dividend yield at the moment. H&M has been doing really well, but over the past month it has declined quite a lot. But in my portfolio it is up by 23%, which is really good, and that is a return for me at £2.21. Next I have Fiverr, but I don't have too many shares in that. I had around £2 worth, I guess. That is down by quite a big 23%. As you can see, Trading 212 also shows the FX impact, which is around 3%. The gain and loss in pounds and then dollars, you can work that out for yourself. But over the past month, as you can see, we have a huge decline, and I think investors are pretty sick of all the volatility, and big declines like this are kind of indicative of, you know, people just selling off loads of their shares because they have no idea where the stock market is heading. But like I said, like I always say, like I always will say, stay invested. That is your best thing for the long term, is to stay invested, because you can see dollar cost averaging, even for this company like Fiverr, if you have been dollar cost averaging, you probably would have been making money, and it doesn't matter if the stock goes down more. Just buy the same amount next month, you're going to be getting more free shares if you think of it like that. EasyJet is up by 40%, so doing really well over the past few months, with the last month not being too good, but in my portfolio is up by around 40%, so that's around a 40 pence increase. Direct Line doing really badly, but I only had £1 in that. That is down by 18%, so that's a 75 pence loss. Lufthansa is doing okay in my portfolio, but I have a feeling, yep, over the past month it has not been doing too well, with May being a very bad start to the month. That is still up by 3% in my portfolio, so that's an 82 pence gain. So Deca DAX plus maximum dividend is up by 15%, so that's a 15 pence gain. Carnival is exactly steady. So BP over the past month has been doing really bad, even though these companies have been making record profit. I don't know what's happened to the share price. Maybe it's the fact that there are talks of windfall taxes and then more taxes being hit on these companies because of their record breaking profits. But anyway, it's down by around 10% on my portfolio, so that's a loss of around £10. BMW is up by 0.38%, which is pretty steady to be asking me. But you can see over the past month it has a huge increase on 11th of May. Now, if you guys know any of these big dips, why they've happened, please let me know, because I'll be very interested in that. But I don't follow every company, because who wants to do that anyway? As an investor, you want to make the most out of your portfolios while also making the most out of your life as well, because you need to enjoy your life. Looking at stocks for me is not the most fun thing. I do look at ETFs more often, but for me it just works more with my lifestyle. So like I said, it's about personal finance. There are always going to be better ways of making more money, but if it doesn't fit with your lifestyle, it doesn't work for you. Like, you can say the easiest job in the world is cleaning rooftops, you can get £500 an hour, but for most people they're not going to want to do that because of the risks associated with it and so many other things. But remember, what is right for me may not be right for you. Next we have Aston Martin, so I only have 1.3 shares in that, and that's up by 42%. So over the past month it has not been doing too well. So Apple up by 17%. Over the past month it has inclined. This is almost exactly exactly the same as Amazon, so maybe the tech sector is not doing too bad currently. Alphabet also up by 27%. Again, over the past month, it has been doing wonders for tech companies, and we have also seen that the S&P 500, as a result, being very technology heavy, has also increased over the past month, although it's just seen a quick decline a few days ago. Alibaba down by 13%. That is not something I'm too worried about. I don't have too many shares in that. Airbnb up by 5%. And lastly, AMD is up by 23%. And I think AMD is a very good company to hold because they are making the graphics processing units for all these handheld devices, which definitely watch this. I do think that is going to be a very big hit. So AMD is up by 23% in my portfolio. That's a 46 pence gain. So in terms of pie, I have one pie, which is the almost daily dividend pie, and I've invested around £400 into this. And so far it has paid me £5.70 in dividends, which I'm very, very happy about. But overall, the value of the portfolio has gone down by £21, so that's a 5% decrease. If you guys are interested into this portfolio, I'll leave a link in the description down below, but I'm going to quickly go through the holdings such as Apple, Realty Income, Johnson & Johnson. You can see many of these companies right now are in the red. We have Pepsi, McDonald's, we have IBM, we have Walmart, we have Starbucks. All these companies you can actually check out in the link down below. If you do sign up through the pie features, you will also get a free share. If I go into my history for my Trading 212 Invest account, you can see the realized total profit and loss is £30. In terms of dividends, I have received £18, so that's not too bad with a portfolio size of around £3,000. But now I want to show you my Trading 212 ISA. So as you can see, the value of my ISA is £20,464, and I have free funds of £571.88. So you may be wondering, how did you manage to have more money than the ISA limit? So I've actually maximized this already with £20,000, and I've already made about £500. If I go into my history of this, you can see my total realized profit is £571. So I have already made £571 guaranteed this year. So within less than 2 months, I've made a return of already 2.8%, which I'm very happy about in this current climate. If I continue getting 1.4% every month, you know, that's going to be a lot higher than actually investing anywhere else. That is the goal, but again, you never know with this, and with trading nothing is certain. I definitely do not recommend it, but I will never be trading with CFDs or with leverage. All I'm doing is just seeing the volatility of the GSPX, which is what I've been buying the most. But however, right now you can see the portfolio is 19,892, and this is because of this stupid thing here. So I actually bought the FTSE 250 for some reason, and as you can see, it's gone straight down, so that's a 0.5% decrease. I'm not worried too much about this long term. I'm sure it will go up, and I'm not too worried about that. But my strategy for my Trading 212 ISA is to put £20,000 into the GSPX. I know right now I've bought the Vanguard FTSE 250, but the GSPX is very volatile, and I did sell out at around £7.07 anyway, so that's why I've got over £500 profit. You may be wondering why I still have free funds. The reason why I want to keep my free funds is I want to get to £1,000 in free funds, and then what I can do is limit buy things with £20,000. Trading 212 is a bit weird because if you want to limit buy something, for example, if I go to buy and then I go to limit and I want to buy however much money worth of shares I have, so I have around £560 and I want to buy it, let's say at £2. It's never going to reach it, but let's see it. So if I go to review order, it doesn't let me actually place a single order worth more than 95% of my free funds. That is why I need £21,000, and then I can just place orders of £20,000, and any profit that I get is very easily calculable. You know, if I get 20,100, that is a profit of 100. Going forward, I do think the volatility of these ETFs, because of the high interest rate environment, investors are going to keep buying and selling and buying and selling, so I might as well, in my opinion, make the most out of the volatility. Even something like the FTSE 250 has been very volatile over the past week and the past month, but I think the FTSE 250 is not for me, so I am going to be selling it. I think I have my sell limit already. No, it has expired, but I'm going to be selling it at around £30. I'm just going to be making the tiniest amount of profit, and then I'm just going to go into the GSPX because I believe in the GSPX more. That being said, I do not recommend trading, but it's not trading in the sense that you see, you know, on the internet where you can lose a lot of money. You don't actually really lose money in this regard. What can happen is that you buy something for a good price, then you sell it, and then it goes up really, really high, and then you're going to have to just spend more money buying it again. So essentially you lose out on your potential returns. That is something I'm willing to do, and that is something my risk tolerance allows me to do. So as you can see, I've already realized a profit of £571, and I'm happy with that anyway. And I have bought 666 shares, so that's very devilish, of the FTSE 250, which I think in the long term is going to be a very good hold anyway. So really, I don't think it's too bad at all. So make sure to check out some of my other videos, and I'll see you in the next video.